So, the Federal Reserve is about to do something that honestly makes no sense at first glance. They're getting ready to cut interest rates, make borrowing money cheaper, right as the stock market is hitting all-time highs. What is going on?
And yeah, that right there, that's the huge puzzle we're going to unpack. Why on earth would the Fed pour gasoline on a fire that's already raging? It's a genuine paradox, and we are going to break down exactly what this means for the market, for the economy, and most importantly, for you.
All right, first things first, we need to wrap our heads around just how weird this is. I mean, we're not talking about your everyday economic cycle here. This is a truly rare moment. But just how rare are we talking?
Just 3 times. That's it. In nearly 30 years, only 3 times has the Fed cut rates when the stock market was flying this high. Now, when something is that rare, you got to pay attention, right? The playbook for this is pretty much empty. So what's behind this decision?
Because if you're just looking at the big headline numbers, this whole thing feels, well, completely backwards. The economy looks great, almost too great for a rate cut.
Okay, so this really puts the contradiction front and center. It's like you've got 2 completely different stories being told at the same time. In one corner, you have every reason not to cut. Strong economic growth, stocks valued through the roof, and inflation that's still hotter than the Fed wants. And in the other corner, just one thing, a job market that's starting to show some cracks.
And this is what the Fed is honing in on. See, even though unemployment looks low on paper, the feeling on the ground is changing. Fewer and fewer people are saying jobs are plentiful, and that is the one crack in the armor the Fed is using to justify stepping in. They're basically trying to patch a small leak before it turns into a flood.
Okay, so the Fed's making its move. What does history have to say about this? Let's look at the bull case, the optimistic side of the coin, and see what the data tells us.
Wow. Just look at that number, let it sink in. 100%. That's a perfect score. Every single time this has happened in the past, the market was higher a year later. No exceptions.
And just to put a finer point on it, we're talking 20 for 20, an absolutely flawless historical record. You just don't see stats like that very often in finance.
And hey, these aren't just tiny little bumps either. The average gain, almost 14%. So yeah, if you're just looking at history, the long-term picture looks incredibly rosy. But there's always a but, isn't there?
Right, because while that long-term view is fantastic, history also throws up a massive warning flag about what could happen right now, in the immediate future. There's a pretty big risk here.
So what's the catch? I mean, it sounds too good to be true, right? A guaranteed win a year from now? Well, it's what happens in the short term. That's where things get messy.
Take a look at this. The short term, it's a total mess. 1 month, 3 months, 6 months. The returns are all over the map. Sometimes up, sometimes way down. It's pure chaos. It's only when you get out to that 1-year mark that things start to look predictable and consistently positive.
Let's be super clear about this. In the first 30 days, it's literally a 50-50 shot, a coin toss. So while you might be looking at a great return in a year, you could be in for a really rough ride to get there. And believe it or not, that's still not the biggest red flag.
Okay, now this is the chart that should give everyone pause. Look at this pattern, over and over again. The Fed starts cutting rates, and then boom, that gray bar shows up, a recession. It's happened time and time again. And if you follow that timeline all the way to the end, well, you can see exactly where we are right now.
All right, so let's zoom out and try to make sense of all this. We've got a great long-term signal for stocks, a super volatile short-term, and this really scary connection to recessions. What does it all mean when you put it together?
And to really get the big picture, you have to ask a simple question. Who's actually winning when the market goes up? Well, the numbers don't lie. The wealthiest 10% of Americans own a staggering 93% of all stocks and mutual funds. 93%. So when stocks boom, the rewards aren't exactly spread out evenly. So what we've got here is basically a perfect storm of competing forces. You've got stocks at all-time highs, with the Fed about to pour more fuel on the fire. You've got inflation that's still not under control. You have a job market that's just weak enough to give the Fed an excuse. And then you have this wild card, the AI revolution, that some people think changes all the old rules anyway. It's a lot to juggle.
So the takeaway? The bottom line? Get ready for a bumpy ride in the short term. Remember that coin toss. But if history is any guide, this whole situation is setting up for a major long-term boom for people who own assets.
And all of this brings us to the biggest question, the one that really matters to you.
In a world with sticky inflation, a volatile market, and policies that seem to benefit asset owners the most, how are you going to protect your own purchasing power?